morning. Thanks everybody for taking the time out to join us. We're going to just jump right into sort of a discussion of the markets. We'll touch on the companies, give the updates, and we welcome all sorts of questions. Nothing is off limit. Well, most things aren't off limits. Yeah, Greg, maybe we'll just start with you. Scott Petsel will be coming in momentarily, as I understand, but maybe just a quick bit about your background and the metallic minerals and metallic group.
Yeah, no, great. Appreciate everyone being able to join us today. It's interesting period in the markets right now, so good time to be talking about silver and copper and other metals, and really pleased to be able to have Peter join us here. My background, I started out my career as an exploration geologist with Plata, which later merged with Barrick Gold. Went on to co-found Nova Gold Resources with a number of other exploration geologists. And over a period of about 10 years, we grew that from a micro cap size company, similar to metallic minerals early days, to over a $2 billion market cap. And back in 2016, myself and a number of other Nova Gold alumni got together and said, this market's looking remarkably like that past cycle back in 1999 to 2001. What a great opportunity for us to come together and look for assets that have, potential to be a similar type of value creation opportunity. With the metallic group, we really had a little different focus than Nova Gold. Nova Gold went after these massive, very remote green, fields projects that were huge, but very remote, and so they had high capex requirements. And the opportunities that fell in front of us with the metallic group companies were things that were in established mining districts next door to, amazingly, three of the highest grade producers for their metals: silver, platinum group metals, and copper in the three companies. So it's been exciting over the last few years, since 2016, 2017, as we started to put these together, to bring these three companies together. The metallic group is kind of an umbrella. We basically share back office support to keep costs lower. That means we have a common, accounting team, admin team, CFO. So that means hopefully more money in the ground, and less in terms of running the companies, and we're effectively seeing that. And it really almost provides us the depth of team as if we were a mid-tier producers exploration team, but we're three very focused exploration groups in the three companies: metallic minerals, Group 10 metals, now Stillwater, critical minerals, and Granite Creek copper. So it's been exciting to see this come together and to see the market respond from really minimal initial early days coming out of that bear market in 2016, 2017 to where we sit today with a combined market cap north of $100 million between the three companies. I think we'll probably talk a bit about metallics assets in particular, but really we're focused three key assets: silver, gold, and copper. We have a particularly strong silver focus, but with the recent 43-101 at La Plata, we now have a major copper resource as well. So I think it's a particularly interesting time in silver, with the assets that we've got, and maybe this is an opportunity, Peter, for you to kind of jump in and talk a bit about the silver market and just kind of where we are today with all the interesting things going on right now.
Well, thanks for that intro, Greg. So just a little bit about myself. I've been researching, writing, and investing in silver for over 20 years. I've written or edited and written several resource investment newsletters. And since the start of 2021, I've been editor of the Silver Stock Investor newsletter. And last year started writing, and just a couple of months ago published a book called The Great Silver Bull that really talks about what I feel is the incredible opportunity that lies ahead of us in silver in terms of investing both in physical silver and in silver investments. So that book, as I say, was launched just a couple of months ago. It's been a bestseller on Amazon since then. I'm really happy with the kind of feedback I've gotten from readers, and I just think that my goal with the book was to cover the entire silver opportunity, everything from a little bit that has to do with its history as a monetary metal, as an industrial metal, to talk about a little bit about how silver is very particular in terms of being both a monetary and an industrial metal. A little bit more also about how the silver market is very quirky in terms of supply and demand, and ultimately how to take advantage of the opportunity in silver. It can be a volatile metal. The investments as well, as your viewers probably know, can also be quite volatile. But that's something as retail investors that we can really take advantage of and make work for us. And ultimately, I explain how I would build my own ideal investment portfolio in the silver sector. And finally, this bull market, although we're still quite early days in it, it has quite a ways to run, in my view. And so ultimately, though, it's of little use if you don't take advantage and lock in profits. And that's actually something that investors can do all along the way during the bull market. But ultimately, to look for signs that the bull market has peaked, and how to take advantage of that, and ultimately, eventually, cash out with your investments in silver. But once again, I think the opportunity is just tremendous. If you look at what happened, our best analog is the 1970s. Silver had a tremendous run. Gold was up 1,400%, but silver was up about 3,700% in that decade. And I think we're set up for something at least as good, if not better, this time around. So that kind of gives the overview of my background and where I see things headed in silver in general. But if you'd like, Greg, we can certainly chat about the markets and where silver is right now in sort of the more near to medium term.
And, I think we'll definitely want to cover that. And I think we both would agree that right now it's still very early days in this cycle. We're probably in the early 70s, if that's your analog, or perhaps early 2000s if you're looking back at the last metal price cycle. Scott has joined us. Scott, you want to say hi to everyone and maybe give a bit of a background?
Greetings, I'm Scott. I am the president of Metallic Minerals and was recently appointed that within the last 6 months. I started with Metallic Minerals in 2016 as vice president of exploration, and I am, as they say, coming in hot. I just arrived from the Vancouver airport, having come from our Keno silver project, and I'll be really had a great couple of days up there working with the crews and seeing the progress of our program this year. And it's been great so far.
Oh, that's perfect. I just quickly wanted to circle back, Peter. You did mention the book and a couple other things, your newsletter, and I guess Metals Investor Forum too. Maybe just where can people find the book and find your newsletter?
So thanks for that, Chris. So it's very straightforward. The book, the easiest way is just to go to Amazon and type in The Great Silver Bull. You'll see that right away. It's available in paperback and in Kindle version. I'm working on an audiobook right now. So besides that, the newsletter, just go to silverstockinvestor.com, and I'm on Twitter and on LinkedIn, so people can find me there as well. And I'm a regular presenter at the Metals Investor Forum, which has events about 4 or 5 times a year, and mostly in Vancouver, usually once in Toronto. That's usually along with the PDAC convention in March. And these are the easiest ways to find me and to follow my work.
Okay, great. So let's talk about markets. There's really nothing going on out there. It's pretty much just, I almost don't know even where to begin. I suppose we could start with what was in the news last week with the CPI print and segue from there to what's coming next week, which would be the GDP number and potentially flashing the R. Yeah, what's happened and what's coming?
So if that's for me,
sure, Peter. Yes.
All right.
Start with you. Yeah.
Let's do that. So the latest CPI number in the US was 9.1. If I understood correctly, today's number for Canada was 8.1. In both cases, we're at 39, 40-year highs in terms of inflation. And there are no signs really that it's slowing down. It's just been, in fact, climbing for the better part of about a year and a half at this point. What's likely to happen? Hard to say. Central banks are starting to get tough, or at least talk tough on inflation. They have been increasing rates. But if you look at where inflation is, say 8-9%, and a 10-year treasury or even a 2-year treasury at this point is paying about 3%, that's a long way from inflation. So if they were actually able and willing to fight inflation, they would need to raise rates above say 8 or 9%. And I think that's not only unlikely, but impossible at this point. Debts are huge across government, business, consumers, student debt, you name it, credit card debt, it's everywhere. It's about, and we talked a little bit before about comparing with the 1970s in terms of the opportunity for silver. Well, in fact, in the book, I talk about this very specifically, and I compare because the 70s is the best analog that we have. And in the 1970s, the debt to GDP ratio in the US was about 30%. And ultimately Volcker, the head of the Fed at the time in late 70s, early 1980, raised rates to 20%, which is just unthinkable today. And in part was able to do that, crushed inflation because debts were relatively low. They were manageable. At current levels, we're at about 130% debt to GDP in the US. And it's not much different in most of the developed world. So for central banks to realistically be able to raise rates enough to fight inflation, to cool inflation, I think is, again, not just unlikely, but impossible. If they actually did that, you could basically assume that the economy would be crushed, and governments, in fact, would see something like 25 to maybe 50% of their budgets just go to paying interest on the national debt. So that's highly unlikely. And so for me, at least, what all of this points to is that they will try to raise rates. They will be raising rates a little bit farther, and it's likely to end up in a recession. They are unlikely to get very far with raising rates. They're likely to stop and eventually cool or pull back on rates. And in the meantime, all they can really do is try to manage expectations, anchor expectations. And that will essentially mean that they will have to let inflation run hot and try and talk tough as much as they can. But the public will clue in before long, and they will see that they have to look at alternative assets to help protect their wealth. And precious metals really are going to be the go-to place for that.
Well, I guess, one of the things that was in the news that people were hanging their hat on was that oil price had come off a little bit. We could look at the 70s and OPEC and stuff like that. So I don't know, Greg, is that something that's going to buy a little bit of time? I don't want to say a consensus, but there seems to be a view out there that exactly like Peter was saying, that the Fed is talking tough, can raise interest rates to a certain point, and then there'll be that tipping point where they have to sort of back off, and that's what people are watching for. So drop in real estate prices, drop in oil, does that buy them a little bit of time and high or low unemployment?
Yeah, I wouldn't be surprised to see, maybe these are the near term highs for the inflation rate, with oil coming down because it's such an important component of everything. It's certainly positive for the mining sector in terms of the healthy profits. If oil prices come back, that'll help margins stay strong, even at these current, price levels. But I think that's a point, Peter, as well. I guess two points onto what you mentioned on the inflation. Even in that period of the 70s, with rising inflation, gold and silver led that rising inflation the entire time from 1970 to 1980. It didn't follow. So the concept that, rising interest rates and rising inflation is negative for gold isn't really held up by, if we look back at a period that was a rising interest rate period, rather than a falling interest rate period we've been in the last 40 years since 1980. And secondly, I think the other thing that underpins current prices for precious metals is with this recent pullback, it's not been particularly deep. These are still good prices for precious metal producers in terms of, but they're supported now, and some of the higher cost operations are now going to start getting squeezed if it goes any lower, particularly on silver, I think. At an $18, $19 price, the high cost operations are going to start to come under pressure here, which should be positive for seeing this as a kind of a temporary position, I would argue.
Yeah, I guess there's the precious metal side, and then there's also the base metal side. And Scott, with our the Plata acquisition a couple of years ago, and the resource on that, primary copper in the porphyry in the center, and so on. So copper demand, and the others can speak to this as well, but with electrification and everything else, Dr. Copper is exploded and now has kind of pulled back, but where's the supply demand factor on that?
Well, I think there's still a lot of room for growth in the copper price as well, and we're well positioned with our La Plata project to continue to add copper resource to the project. But you just think about this transition to the new green economy that we've all talked about, and you think about the idea that every one of these electric vehicles is going to require about 80 kilograms of copper to run it. We need 400 kilograms or something on that order to wire every new house. But aside from that, we're going to have to reset the whole grid that supplies this copper and allows for the demand to happen with the increased load on the electrical demand. And so when you think about that in the context of our La Plata project, like I mentioned, we're well positioned. We could really call this project an electric metal project because it is primarily copper, but we also have gold and silver, which are also very, gold, silver, and telluride actually. But you think about the conductive metals, well, gold and silver are the best, and silver is really in terms of industrial use in our solar fields and our solar panels. And so as those things continue, the demand will continue, and the price will has room to go, and we're hopeful to generate the next supply for those metals as their demand is increased.
And what's interesting to add to what Scott was just saying from the industry point of view, the discovery rate for whether it's copper or silver or gold, name your metal, really has been much less discoveries per dollar invested in exploration than in past decades. And there's a reason for that. Basically a lot of the low-hanging fruit, the deposits that were right at the surface that were obvious, have been found. And if they were economic, they've been turned into mines. And so now some of the very largest producers, have been running for decades, and they're getting deep, and they're getting to the point where they're going to need to be replaced. And when we look as an industry out there, well, where are the new really big deposits, whether it's copper or silver or gold? And there have been a handful of discoveries, but nowhere near what we need to see as an industry in order to just keep steady in terms of production. And I think that's going to be really, this is entering a period of supply constraints. Even outside of what demand is doing, the fact that the industry just is not bringing new metal to the table And I think coming out of the intense bear market that we just saw as an industry from 2011 to 2000, and let's even say 2016, but I think in some ways it's still we're still in a bottoming process. The industry has been very conservative to redeploy capital investment in these very capital intensive projects. And the lag period to go from new discovery through drilling and then engineering and then to get your permits and then to build the mine, some of these deposits, especially the big ones, are measured in decades. So even if suddenly you have a discovery, that metal isn't going to come to market for a very extended period. And that's really what sets up the cyclicity that we see in the mining sector. So I think, we're very fortunate that we've got two assets, one in silver at Keno Silver, that's a world-class silver district, and a second at La Plata, which is silver and copper, was a very high-grade silver and gold producing district that we've got already in the wings. And we can already see that these have the grade and the scale potential of what the industry is going to be looking for. Maybe Scott, maybe you could just give a high level on Keno and La Plata, just kind of introduce the viewers to those two projects, and maybe just a quick synopsis of what we're going to be doing this year.
Sure. Our two key projects, our Keno Silver project and as I mentioned, I just returned from our Keno Silver project, and it is within the Keno Silver District, which has had over 200 million ounces of historic production and currently has over 120 million ounces of existing resources and reserves that are held by Alexco. And we're mostly all aware, I think, that Hecla has made an offer to take over Alexco. The deal should close hopefully within the next couple of months, and there'll be a real transition in the district to have what is the United States' largest silver producer become also Canada's largest silver producer and operate as the third largest silver producer in the district. I think that's really significant because they'll bring fresh capital and fresh resources into the district to do the work that they're planning to do to really buff up the district and their operations there. And that will have a positive effect on our efforts in the district as well. But we have 170 square kilometers now of the district's second largest land package at Keno. And we are pursuing traditional silver, lead, zinc veins with drilling, as well as making new discoveries on the eastern part of the district that are more bulk tonnage type targets, where we're finding very interesting results that relate to discovery that we made in 2020 that generated from soil sampling, really, and where we generated a 5 kilometer by 2 kilometer wide soil anomaly, and then did the systematic work to come in and get the first drill holes drilled and make the discovery there. And now we're currently drilling on that target in East Keno. It's called our Fox target. We're working diligently this summer to drill around 3,000 meters to move several of our targets towards resource definition or 43-101 compliant inferred resource definition. Right now, we've got inventories at Fox, Caribou, and our Formo target in the district, and each of those is going to see a bit of drilling as we complete this year. And so far, so good, I'd like to say. Guys are working hard up at site. Sorry, go ahead.
Yeah, maybe before let's just stick on this, because you brought up the Hecla news. I think it's really worth maybe chatting a bit about that. I mean, I think this is it's an exciting development for the Yukon for sure. I mean, they're really kind of the first of the bigger producers to come into the Yukon, and we've got recently Victoria Gold had an investment by Coeur. You had an investment by Rio Tinto into Western Copper. But this is the first bigger producer to come into the Yukon. I think it really speaks highly to the caliber of this. And when you take a look at what this means, Scott, so you mentioned they're already the biggest U.S. producer. they tout themselves as having two of the highest grade silver grade deposits at their deposit over Greens Creek in Alaska, and then their Idaho deposit. And yet the grade at Keno Hill is twice the grade of those two deposits at over 800 grams. And production-wise, this is going to be a 30 to 40% boost in production. So they're going to become Canada's largest producer. It's even better grade than their two deposits, which are in the top 10 for sure, and probably even in the top 2 or 3 already. So it really stands out. It makes sense why they were looking at this asset. And I think the other thing about Hecla is these are guys that have deep expertise in both underground and open pit mining. So it's going to be a great fit for the Keno district, particularly the stuff that at Alexico right now that they're developing, which are these relatively narrow but extremely high grade veins. I think this is an ideal fit for them. And so I think, we're excited to see those guys come in and invest the capital, get that mine fully up and running. And we can see with our large position to the east and to the south in the district, with the consolidation that we've done over the last couple of years, the opportunity for discoveries we make and deposits we bring to resources to be very valuable in the context of a kind of a unitized district.
Maybe just circle back and expand on on that as a subject. So that's a pretty meaningful M&A move in the silver space. I mean, you could kind of point to some reasons why that was. There may have been some urgency there and so on. But Peter, what do you see moving forward for M&A in the space, given price and opportunities out there that some of these majors might really be, twirling their mustaches over?
Sure. I mean, if I kind of refer back to what Greg was saying earlier in terms of copper deposits and how few have been found in the last decades, it's no different in silver. And silver is is so particular because it is a relatively small space, and there are relatively few larger producers. There's a handful of mid-tiers, and then there are, I'm going to say, a relatively larger group of explorers. And we definitely need, I think, to see some consolidation happen. I think it's likely. I also think it's likely probably at each level. Perhaps less so at the explorer level, but at the mid-tier level for sure. And at the higher level, well, because there are so few players to begin with, not that it wouldn't be helpful, but it's probably just a little bit less likely. But there's no question that there are some advantages, some economic advantages, and some synergies to be found through that, as I say, at pretty much every level. So I think that's probably something that we could expect to see more of in the next several years.
Yeah, well, it seems like jurisdiction is really counting, maybe now more than certainly than I remember. But it's been a tumultuous year, let's call it. But and then you can point to supply chains, and you can point to the Ukraine and so on. You can point to Central American policy changes, if you will. But jurisdiction seems to count more and more, and that's something that we're obviously focused on with Keno, and Hecla's move there now kind of reflects that, and La Plata as well, which is in the great state of Colorado.
And I think it's worth, just kind of highlighting the way the modern mining industry is set up. I mean, it used to be the big companies did everything. They did the exploration, they, found the deposits, they developed them into mines. But our industry has evolved dramatically over the last couple of decades. I think it's something like 65 to 70% of all discoveries are made by juniors. And the model that most of the majors, they don't have big exploration teams. They have exploration teams around their existing mines. Definitely, MineX is one of the most important elements, but that's not looking beyond the kind of, the head frame and the mill. And so these larger producers are all reliant on identifying high quality up and coming assets that are controlled by juniors in order to be able to enhance their production profile and to be able to bring growth, because they just don't have these big exploration teams and are not spending money on exploration. And that's a win-win for both parties. That means that these very experienced exploration teams can be highly focused on these opportunities like Keno and Plata, advancing these. And then at the right time, you see opportunity for the bigger companies to come in, pay a premium for these, but then because they traded a premium to their net asset value, it's a win-win for all parties because they get the growth they need as the bigger company, and the investors who came in at the higher risk period of exploration, but expecting a higher return, often are really nicely compensated for that investment risk. And as Peter was just saying, if we look in the gold space, there are hundreds and hundreds and hundreds of explorers and developers and even producers. And when we look in silver, it's a much smaller universe. There's only a handful of larger companies, double that for the mid-size. And in terms of up and coming exploration projects that are really silver focused, there's just very, very few opportunities out there. And so I think, these are the early days. We've seen a handful of acquisitions in the silver space here in the last couple of years. I think the Heckel one is a major kind of bellwether, and I think we're probably going to see more of that. It's an exciting time, despite the very depressed markets out there. The reality of the lack of supply and the lack of new discoveries is really going to come home here to roost for the sector.
No, it's a great point, and I'm going to kind of derail our momentum here a little bit because there's a couple of really good questions that have popped up, and one of them kind of is a reminder that not everyone has maybe as many birthday candles or as much experience in the space, or are quite as much historians. So we framed up the parallels with the 70s, for example, in terms of that as the best analog. But I'm just going to read the question verbatim, and then maybe Peter, you can jump in on it, and Greg, I know you'll have some insights there as well. Scott, you and I were kids, so we don't remember. Just kidding. Okay, so the question is: in the 70s, we didn't have a metals crisis with chips, etc., and quite all the supply issues, or did we? So the situation is not 100% comparable with now. Question: why the comparison from the 70s to now, and is it only because of interest rates? So maybe just frame up that analog that you see.
Sure. So, the best, to my knowledge, the question is, or the participant is correct. I don't know that there was an issue with supplies of metals in the 1970s. There certainly was an oil crisis. There certainly was a rising trend in interest rates, a very marked rising trend in interest rates, although the rise was not a straight line rise. It was actually it came in waves. There were 3 clear waves of rising interest rates that would fall off. They'd get fought by the Fed, and then they'd back off. They would rise again. And anyway, so that happened 3 times in the 1970s. And then there's the debt issue. And it's true. I mean, I've said it many times. History doesn't necessarily repeat, it rhymes. But what I would say is that, if anything, because of debts and because we are having supply issues with metals and energy and all sorts of things, and especially now in the last several months, and likely ongoing for some time because of the war in Ukraine, it's almost like it's the 70s to another degree, because all of these things are simply compounding the problems, the issues, supplies, costs, and how we and the ability we have to deal with the problems. And so I think that it's just going to exacerbate the kinds of increases we're going to see in the prices of both base metals and precious metals. Greg, I don't know if you'd like to add something?
I agree. I think probably because we didn't really have the junior major combination that I was just talking about on the exploration side. It was all being done by the producing companies. I would argue it's been exacerbated because if 65 to 75% of all the discoveries are being made by juniors and they're starved of capital in these periods of these bear markets, that means the discoveries aren't being made. In addition to the fact that in today's market, as I said, the obvious targets that were sticking out of the ground have already been developed. So we have to look deeper. We have to look in more remote areas. We have to use new techniques. I would argue that, yes, we probably have exacerbated this interest rate related component with the lack of supply from the industry. And we've probably made these cycles more extreme, not less, in terms of that. And so it's really kind of set the perfect storm for even higher metal price pressures as we move into this next phase of the cycle.
I just kind of like to add something else to that. There's a very interesting chart by a group called Crescat Capital that compares the capex cycle of silver miners with investment in terms of exploration, and it has dropped off. I mean, like a rock. The silver producers have really cut back on their spending in silver exploration. And so, as you mentioned, Greg, that really has fallen to the juniors. I do think that, if I think in terms of specialization, it does obviously make sense. It's almost surprising we didn't get there earlier than in the last couple of decades, but these are cycles and so on. But it makes sense that juniors you'd have a group specializing in exploration, because it takes a unique set of talent and skills, and to be able to advance exploration. So it also makes sense for the mid-tiers and the larger producers to focus on what they do best, and then allow their share prices, help their share prices increase over time, and use that as a currency to go out and acquire the juniors. I just think that it's a better way to manage things. If we're there now, chances are it's because it made sense to evolve that way. But as far as viewers and participants are concerned, I think that they're actually quite lucky, because the opportunity right now with the sell-off in silver prices in particular has just made the value that much deeper. And so, the bang for buck. I mean, some of these companies are trading at very small multiples of their cash in some cases. So, the opportunities really are tremendous right now.
Yeah, particularly. And I think scarcity, people should be thinking scarcity value. I mean, if you're fortunate enough to have a company that's they've established the strategic value of something that's got the potential to be a tier one asset in your metal, those are exceedingly rare and valuable. And the market may not be valuing them right now in the marketplace, but there's a difference between the price something sells at and what it's worth. And I think that's really the key here. I mean, if you look out, there's something like 2,000 listed junior exploration companies in Canada. And we say, okay, how many of those companies really have something that could be a potential tier one asset? And I think if we're generous, we could say maybe 10%, right? Maybe. That's probably stretching it, probably 2%. But, we're looking at a situation in our metallic group where we've got 3 companies with 4 assets that we could argue all 4 of those assets have the potential to be tier one assets. They already show the grade, scale measured in kilometers, and they're adjacent to the deposits that have already gone into production, or some of the highest grade for their metals. And so, this is a challenging point in the marketplace. There's no question. None of us are happy to see the retracement. It's been a grueling market since the last kind of, I would say, medium-term peak back in September 2020. Where the market got a little over enthusiastic. Everyone was bullish. And now, Peter, we're at the opposite extreme where, people want to throw themselves out the window and everyone thinks the industry is going to crater. And I think oftentimes when we see these wild sentiment extremes, that's where the opportunity lies. And right now we're at one of those extremes on the downside. So I think for investors looking at high quality opportunities, particularly in silver right now, but also in copper with the recent pullback, I think this is a fantastic market period to be looking at good quality names.
Exactly.
That's a good jumping off point for. Oh, sorry.
Do you mind if I just point out something quickly? Yeah, and that I do talk about this very point in the book, and the fact that larger managers, fund managers, are in many cases just not able to play in this space. They have all sorts of restrictions and requirements when they manage funds. And that's where this is the advantage to the retail investor, because they can access juniors. They can use this cyclicality and the volatility to their advantage. They can be patient. They can buy these companies that are listed on exchanges or have small enough market caps that the larger fund managers just don't have access to or are not allowed to invest in. And so again, this can be very much an advantage for retail investors, and it's a whole space that many others simply cannot play in, and that's for them. That's for them and for us to take advantage of.
Oh, that's a great point, Peter. Many people don't appreciate that it's one of the few times where the retail investor actually has an opportunity. If they do their homework, if they've got an advisor or a newsletter that they follow that can help them to kind of filter, you are able to invest early. This is like being a venture capital investor in a public market, and the big players cannot come in until these things hit the next that milestone of say 100 million market cap or 500 million market cap or even $1 billion sometimes for the bigger funds. And so, yeah, if you play it well, and if you're astute in terms of recognizing where you are in the cycle, and then maybe you're looking with some aid from a newsletter writer or advisor to help you pick out those quality names to follow. Mining is one of the few spaces where historically people looked for 5x, 10x, 20x, even sometimes 100x type returns. In order to get those kind of returns, you need to be buying at these extreme parts of the cycle where we are today.
Okay, maybe we'll just take a bit of a left turn because Scott, you were giving a nice overview of the projects and so on, and then I saw a rabbit hole that I thought that I could drag us all into, and then we segued into these other subjects. So I just wanted to circle back real quick, and let's just talk about La Plata a little bit. I mean, there's a epithermal vein halo of silver and gold around it with the copper porphyry, and there's lots of activity planned for this year and so on. So just 1 second though, we do have 3 really good questions I want to get to, and I promise those who ask the questions, I promise we'll get to those right after Scott. But maybe Scott, just talk about that, and then later on we can put it in the context of circling back to silver as industrial demand, because with industrial demand, increased silver production as a byproduct of base metal and so on. So maybe Scott, just take us back to La Plata, run us through that with jurisdiction and what's happening there.
Yeah, our La Plata project is a great project. It's in Southwest Colorado. Colorado has seen a litany of producers over the years. It's got a long history in mineral exploration and mineral production. It is the home to producers currently, like Cripple Creek operation for, I just blanked on the name of the company, but the Henderson Mines Freeport. Yes, yeah. Exactly. Newmont's Cripple Creek operation and Freeport's Henderson Mine. There's been over 500 million ounces of silver produced in the district or in Colorado. It's a great jurisdiction to have a property in. And we're really lucky to be where we're at in La Plata, because this is a district that was discovered, silver was discovered in the district in the 1700s by the Spanish explorers. And over time, the small miners came in, with the gold rush in the 1800s, and began to exploit these high-grade silver, gold, telluride veins, these epithermal systems that surround the copper porphyry system that we're now working on, and ran small mines on these things, very high-grade operations, small-time production, but
essentially ran these until the World War II, when the War Powers Act shut down the mines in the district. And the majors, after the war, came in and really focused on this copper porphyry mineralization in the center of the district. They had a very fractured land package when they did, but we're talking about Rio Tinto and Freeport particularly, that did work in the district. For various reasons, they let the properties lapse. Some astute investors picked it up and recognized our ability to kind of come in and do work based on Greg and I's history with Nova Gold and our work at the Galore Creek project, which is a very similar project to our La Plata project in terms of the geologic style and the potential. And so in 2019, we picked this thing up. We've been very systematic at doing the work. And over the last year, we were able to go in and do confirmatory drilling and confirmatory underground sampling, as well as geophysics and a lot of surface work to really gain a better understanding of the district and to understand the potential for this district to grow. But since 2019, we really consolidated 2/3 of the district. So we have a very significant land package that's going to allow us to pursue these ideas and exploration that we've come about through this systematic work and the application of higher technology, including AI work, artificial intelligence, applying this technology to the data that we've collected that's really identified as many as 16 new potential porphyry copper centers that have not been tested historically. And so we're undergoing. We've just completed a geophysical program on the project that's going to help us focus some of our targets, some of our drilling on some of our targets. And we'll be launching a drill program there very soon to not only expand the resource that we were able to bring to the market this spring, which is nearly 1 billion pounds of copper equivalent and includes 15 million ounces of silver. So we'll be working to expand that this year with a few holes and also testing some of these new targets that look really exciting from a new discovery standpoint.
That's perfect. And with modest drilling, almost 1 billion ounces, almost 1 billion pounds, pardon me, of copper defined with 16 additional porphyry targets to look at. We have, that's a lot of exciting work and news flow to come. Now, I promised that these questions would get asked, and they're coming in. So where to start? Okay, well, since Scott, maybe we'll start with you again on this one, and then Greg, you'll have some comments too. It's impacted the junior space quite significantly of late. So how do you see the industry-wide manpower issues and geochemical turnaround issues affecting our various projects? So lag times on assays, I guess, is the question.
Yeah, we've been very fortunate in terms of our team. We've got a very professional and dedicated team, a great group of people that we like working with, that like working with us. And I think a big part of our success comes with consistency of our team and being able to build experience and build knowledge on our projects and apply that to making these new discoveries. So internally, we're good on the manpower side, but it is clearly affecting the industry in many respects, and particularly with the lab at this time. So we've got our first samples in from some of our projects. We're still awaiting those results, and I think that it's going to be better than it was last year in terms of receiving those results. But we're already starting to see a little bit of stress in the labs in terms of the analysis and relating to the manpower issues.
I guess one positive, though, Scott, would be the fact that it was very, very difficult to get drill companies last year. But for companies like Metallic Minerals that are fully funded for our programs, it's an opportunity for us to be able to secure the best quality drillers and contractors to do work. So we're in a good position that way because of our funding. And so we can take advantage of that. And that pause is a good one, actually, for the industry, because it was we were pushing to the seams in terms of being able to get good quality, work. So, that's actually an advantage for us right now.
So, Peter, I'm going to come back to you in just a second with some. We're going to test your silver markets knowledge here in a minute with some really with some great questions. But just Scott, one more for you. Technical question about the Plata. Any impurities such as arsenic or other elements that may that would influence any production scenario?
Well, we're still characterizing a lot of what the ore body looks like and is. There is a technical report out that discusses sort of mineralogy and geology that can be referred to. I believe that's available on our website, Chris, if somebody is interested in reading it. The interesting thing about La Plata is not necessarily impurities, but the fact that the district is really well known for telluride minerals, and they're accessory minerals to the ore. And telluride is one of these minerals that's on the U.S. critical minerals list. And so we have opportunities here not only to kind of pursue the copper and build out our porphyry copper resource, which could grow substantially, but also explore these narrow veins for silver and gold and telluride minerals and contribute to the success of the project, but also this requirement for critical minerals as we move forward.
Okay, Peter, you're up. I think I might attach a rider to this question. That's a question of my own, but we'll start with silver-related question, which is, with prices having fallen, how likely is it that a silver producer would buy long contracts on COMEX, take physical delivery to meet its own contracted sales rather than deliver silver from its own inventory while it waits for higher prices?
Hey, so
a crafty move. Yes.
I'm gonna give my own disclaimer, which is that I'm no expert on futures when it comes to silver futures and the COMEX. I'm actually reading that question myself right now, and I'm trying to understand really where the advantage would be. I mean, if this producer is producing silver, really they'd need to have the funds to go out and, on top of producing their own silver, go out and buy silver contracts, wait to take delivery. I guess it would depend on things like the quantities as well. And there are some fees, is my understanding, with taking delivery like that. You're not getting spot prices. You're paying what apparently I've heard recently are historical highs on 1,000-ounce bars, which are the industrial type silver bars. So my honest answer is I don't know if somebody would do that and exactly what the advantages would be.
I guess something that I would look at that and scratch my head a little bit. And again, not only not an expert, less than a novice on something like this, I would say, but taking physical delivery on any quantity of silver, just from a logistics point of view. But maybe a related or a alternative, why no share buybacks? If you do have a strong balance sheet and if you're one of these companies that's been cut by 60-70%.
Exactly. I mean, the only scenario under which I could see that this would make sense is if they have commitments to deliveries and their own production costs are higher than spot plus, whatever premiums there are right now on these COMEX bars. That's where I could see this making some sense. Otherwise, I deliver my own production and leave it at that. I mean that.
Well, I guess there's two points I might add to that. One, the market doesn't like companies hedging. They don't, and it's very risky. We've seen a couple of examples even in silver recently where hedging went very badly, and sometimes even Barrick Gold, really, they lost their shine because of that massive hedge book back in the 2000s. And had they covered it right at the bottom, they would have been heroes, but they didn't, because it's very hard to know when you're at the bottom. And so in general, the market doesn't like to see companies hedge. They want to see them have that exposure. But the mining industry, because they've cleaned up the balance sheets, they're making cash and cash flow. We're starting to see more companies offer dividends. I would see dividends and buybacks with a healthier industry really, be something that we will see more. And I think the mining industry, Peter, is probably at the strongest in terms of as companies, probably the strongest we've seen in decades. And some of these companies have got, strong free cash flow. They're healthy. And they're doing well. And compared to other sectors in the general market, it's one of the best and most attractive areas in terms of price to cash flow and these other conventional metrics. It's no longer just I want exposure to hard assets, which is a really valid investment thesis. But these companies are really healthy right now, and many of them are in fantastic shape, and that's really good for attracting new investment, especially the big funds into our space. And I would, historically, in terms of percentage ownership right now, silver and gold, we're really at lows relative to past decades in terms of personal ownership and institutional ownership and exposure to precious metals. And so as that pendulum swings, and we go back to this kind of 5 to 10% allocation that a lot of people historically advocated for, that could be huge in terms of additional demand for investment, precious metals, and the impact that can have on price. And that was a huge part of driving the price back in 1980, and a huge part of driving the price back in 2011 to the highs was that surge of investment demand that came in those, particular last kind of third of that market.
I just kind of want to comment a little bit or add on to that. I haven't seen the data very recently, but up until maybe about a quarter ago, what I saw absolutely corroborates what you were just saying, is that the mining sector was actually probably the single most profitable sector there was right at that point in time. So as I say, that's probably very similar still today. It's not all that long ago. The PEs were low. The yields were high. You've got some companies yielding having dividend yields anywhere from 1.5% to up to over 3%, which is just tremendous. If you look at what you're getting on, a GIC or a certificate of deposit today, or your bank deposit. So of course there is obviously somewhat more risk with a large mining company, but these days at such low PEs, it's a tremendous place to get value. There's no question about it. And anyways, that's what I wanted to just add.
So yesterday when we were doing a little bit of prep and bouncing some thoughts around, Peter, you cited a all-in sustaining cost kind of average for the silver industry. So maybe just circle back to that for a minute, and then the add-on question or the related question to that, and maybe Scott, you can jump on this part as well, is so consider the AISC, and then to what extent can new technology help lower exploration costs to offset some of those increasing costs of production, obviously the oil price being one of them. And maybe, Scott, a couple of examples of things that we've been using to good effect. So, Peter, AISC.
So AISC is, from my research, about $18 an ounce. And I was asked, I had done an interview actually back in June at PDAC with Kitco, and I was asked, where's the downside risk? And I said, I think that the overall average production cost, all-in production cost, could certainly help to point to a floor. It's obvious that you can have a spike below that, but not for long. It wouldn't make sense for producers to keep producing much below production costs. And so if we see this floor right now around $18, then it makes sense that this makes for a great time to be buying silver. There's little to no profit for miners. And so more than likely the bias is to the upside at that point. And what was the additional part of the question after that, or was that for me?
Yeah, well, maybe we'll just jump right over to Scott on it. It was talking about what some of the new technologies and so on that are out there that you can help bring those AISCs down, and that's primary silver, I assume. So we can after that, maybe go back to talking about some of the silver industrial. We're at an hour, 5 minutes already. I can't believe it's gone so fast, but everyone's hanging with us, so we'll just keep it going for a little while if everyone's okay with that. So Scott, what are some of the new technologies out there, and what are we using?
Well, I'll just say it is the application of new technology that really helps us efficiently focus on the higher grade potential targets, not higher grade necessarily, but higher ranking or best priority targets for us to help make discoveries more efficiently and quicker and at a lower cost. And one of the applications that we're using this year is we're flying a LiDAR survey over our Keno Silver District. And this is a very high resolution sort of laser pulse at the ground that gives us great definition of what surface looks like through the vegetative cover. And that allows us to see lineaments in the rocks that we may not have seen earlier that can relate to veins or other structures that are indicative of the geology or help us resolve the geology that allow us to be, as I said, more efficiently focused on where we need to look to do the work that we do. And so that's just one example, but there are many, and we're using a lot of technology on both of these projects to really just shorten that time period from the old days where you got out with a pick and shovel and banged rocks and did drilling and did poking around with drill holes everywhere before you made these discoveries. Now we can pinpoint much quicker and more efficiently using the technology to be more efficient and to deliver resources quicker. So
I think maybe with that as well comes just kind of increased, I don't want to say expertise maybe on what types of technologies provide best information for what type of deposit and what type of area. And structurally, we've been using some of the deep penetrating IP with some of the M-Group projects, and like you said, the LiDAR, but utilizing things that are very specific and to give the kind of information that's helpful for then the subsequent drilling and so on.
It is very important to stay on top of the technology. So you have this toolkit of things that you can apply to your various projects, and some will be applicable and others won't. And so having that expertise in-house helps us delineate what technology is going to apply to what geologic model to help us make these discoveries. So
yeah, I guess Greg, I was just you're about to jump right in, but add in maybe a little bit of a discussion about some of the AI and machine learning technology that we've been employing.
Yeah, that's what I was going to add. So, Scott's talked about some of the new tools and techniques that are applicable to individual projects, and a silver-focused project might be different than what we do with a porphyry-related project. But a lot of times, it's the same tool. That's a big part of it's being systematic, applying that data and creating these really deep data packages, which are perfect for machine learning and artificial intelligence. And so, Metallic Minerals, and actually the entire Metallic Group companies, all three of them have been working with gold spot discoveries and going through a process of taking this big data package, and mining and exploration is really a great big data type target, and to take these sophisticated techniques to start to understand how do all these different data sets that are not related to one another, other than the fact that they're all over the same geographic area. And how do you relate that and start to see the subtle patterns and relationships and vectors that are in that data? And so, yeah, we're excited to be working with those guys on both Keno and La Plata. As Scott mentioned, they've identified, 16 new potential porphyry and epithermal centers at La Plata. They've done similar kinds of work at Keno, and it's giving us insights that hopefully will allow us to shorten that timeline in terms of going from recognition to drill hole discovery to resource. And I think this is something that's going to be huge in the mining space over the next decade. I think it's going to be the area that mining hasn't really seen this applied yet. But artificial intelligence, machine learning, taking these big systematic data sets and making the discoveries, I think this is going to be huge. And companies that can do it well will have a huge advantage in terms of leveraging that technology.
I think really good success with the other metallic group companies with at Stillwater Critical Minerals in Montana, and with Granite Creek up in Yukon as well.
Yeah, for sure.
What we haven't talked about, and that's just a testament to the fast flow of the conversation, but we haven't talked at all about Metallic's alluvial projects. And I think we should, because really quite unique and nice potential, really interesting, and could be an interesting season. So let's just talk about that real quick, and then Peter, I want to circle back and maybe we'll wrap it up with some a little bit of market talk and with some something for people to get enthusiastic about in terms of hope/potential after a little bit of a beating here. So
yeah, that sounds good. Let me just quickly talk about the alluvials, because this is something that's a bit unusual. But many people may not be aware that when Scott and I were at Nova Gold, in the bear market of that 99 to 2001 period, we had acquired a company with a very large land package that had an operating sand and gravel business in it, that actually produced a little gold as well. And that brought in $1.5 million a year during that bear market period. So it was self-funding, and it allowed us to position Nova Gold to take on the Donlin asset that became, one of the world's largest gold systems, through our exploration activities. And so we had an opportunity a couple of years ago here in Metallic Minerals to pick up a large unmined land package up in the Klondike gold fields, this famous gold fields. It's produced over 20 million ounces from the gold and the gravels. And this was the eastern extension of that Klondike gold fields. The area had been the source of the water dams and power for the bucket line dredges from the 1920s to the 1970s, so it didn't get mined. They took those out in the 80s, and we picked up this large package. We've got, 6.5 miles of it that's already under lease and fully permitted for mining. We've got operators that have been drilling and doing bulk samples, and we're really on the verge of seeing those start to move into production. And the opportunity here is effectively for us to be able to get multiple operators all producing gold, and for Metallic Minerals to take a 10 to 15% royalty directly off that production. And over time, because these are smaller companies, they're very established, they're very experienced, but they don't have exploration teams. So we acquire the ground, we get the permits, and we basically bring these guys in and give them enough ground to operate for 5 or 10 years. And over time, we should be able to build a nice portfolio of producing royalties from this that can be a self-funding mechanism. Lots of opportunities we can consider at that point in terms of how to best maximize that value. But this is really kind of a sustainability factor for us and a unique opportunity in terms of having that in our portfolio.
Okay. Yeah, we would have been remiss if we didn't talk a little bit about that, and should be plenty of news flow coming just in general from the company here in the next weeks and months. So, Peter, maybe let's just wrap it up and give the audience and the viewers and everyone else who will see this and us your thoughts on where we're going in the next weeks and months. And yeah. Oh, you're on mute.
Thanks for that. So sure. I mean, if you look at where we are, obviously there have been some big drawdowns on the silver price, precious metals, base metals, even oil is off somewhat. And I think that the market is looking ahead, which it always does, at least sort of 6 months or so, in terms of what we could be headed towards. And if you look at, I think one of the best indications is the 10-year Treasury minus the 2-year Treasury, and we're actually at a negative differential there, which means we're facing a yield curve inversion, and over the last 40 years, that's always predicted a recession. So, recession seems likely. That's what the market seems to be pricing in, and the concerns have caused hard assets to sell off somewhat. What I would say is that, first of all, with with metals and all the hard assets that have taken a hit. There's always a strong rally that follows considerable sell-offs, and I think that we've hit a point where there's such negative sentiment right now that we're very much, or I should say, the odds are very high that we could see a rally. Actually, whether it's now or very soon, I think that that's something that is probably in the cards. How long it will be sustained is something to be determined in terms of how the Fed acts, in terms of how many rate hikes we see, the size of the hikes and the number of hikes left. But there is a really interesting, and this is a little bit sort of anecdotal, but if you look at I believe it's a 2-year Treasury yield, it tends to peak before the Fed's rate hiking cycle peaks. And it peaked, the 2-year Treasury, if I remember right, peaked a little over a month ago at around 3.4%. And so if that's the case again this time around, then we may only get one more rate hike. It's not consensus. I realize that. I'm probably going to get a lot of people disagreeing with me, but we could very well just get one more rate hike of maybe 75 basis points at the end of this month. If I think there are some still relatively strong odds, we'll see one more perhaps in September. But if you look at the forecasts, the peaks in the rate hiking cycle initially, if you go back maybe sort of 6 months or so, were for that peak to come sometime at the middle of 2023. Then they were dialed back to early 2023. Now they've dialed back to late 2022. So again, I think that we could really be surprisingly nearing an end to the Fed's rate hiking cycle. And that has almost always kicked off a new bull market in precious metals. So that's certainly something to look forward to. I mentioned sentiment before. Sentiment is very low. Greg and I actually chatted a little bit before this call started about some indicators, one of them being the Bullish percent index in gold miners. And if you look at that, that's very low at this point. I think that in the last sort of 5 years, the only time we were actually lower was at the peak pandemic panic. So March of 2020. And then we saw what happened to gold and silver stocks at that point. So I'm not saying we're due for that kind of rally right now, but it would be difficult to get better value than you can find at this point in this sector. So things are really lining up. People should, I believe, take advantage. And perhaps one of the best ways is to do it in increments. You don't have to jump right in. And I think one of the best ways to, if you're interested in this sector, is to make a small commitment to a stock that you like. And even if it's a third of what you intend to place in terms of full position, and I use that technique myself. It kind of forces me, the fact that I've made that commitment and spent some money, it forces me to follow it very closely, almost on a daily basis. And I wait and I watch. And if I see it pull back further, I might decide to average down a little bit. If I see that it starts to run up, then I might decide, okay, it's time. Things have really sort of turned around. We've seen the bottom, and I make the rest of my allocation. Just overall, I think that there's tremendous value, and people really need to be involved in this space. Inflation is not going away. It is going to define the investment landscape for probably the next decade, if not well beyond that. So this is a space you want to be involved in.
That's great. Yeah, I'd echo that as well. And I think, Metallic Minerals and the other companies in the metallic group are all well positioned to be able to prosper in this environment. For Metallic Minerals specifically, we have 2 active drill programs at Keno Hill Silver and at La Plata, geophysical programs that we're undertaking on those projects, the work on the alluvial. So lots of exciting things. We're funded fully for our programs and objectives to our next major milestones on the company. And so I think this is a great time for investors to be, looking at this entry point here, as you said, Peter, in a great market, position. We may see more weakness. We can't predict, but the odds now are favoring, the upside with pretty minimal downside risk at this point, I think, in the sector. And so it's a great time to be looking at high quality names, and a great time for metallic minerals to be, well funded and undertaking these programs.
Absolutely. Great discussion. I think maybe we will pull the plug there. There are just, we could keep going and going, but I would really, we really appreciate your time, Peter, and for everyone who's joined us. And we will be circulating a recorded version, so that'll be on our YouTube site, and we'll send links around and so on. But there's with so much coming and so on, Peter, I think we should do this again in the fall and see where we're at, and enjoy another good, rousing discussion, and hopefully we'll be in a roaring, face-ripping rally at that point.
Sounds great. Well, thanks for joining us, everybody.
Okay, thanks all.
Bye. Thanks, everyone.
Yeah, bye-bye.